Good day traders, this is Roger Scott from Market Geeks, and today I have a new video tutorial for you. Before I begin, I'd like to remind you to visit Market Geeks and download your free swing trading report. And don't forget to subscribe to our channel for swing trading videos and trading tips. Many traders who are starting out have a strong belief that swing trading has to be complex to be profitable. I'd like to reiterate again, as I have mentioned many times, this is simply just not true. There is no correlation between complex strategies and profitability. I am a victim of this as well. You probably read my story about how I tried to learn a modified Elliott wave theory several decades ago. Needless to say, the only thing I learned from complex strategies is to keep things as simple as possible. Today I'm going to show you one of the best techniques for managing risk and finding a trending market. This is not a complete strategy, but some pieces of the puzzle for you to understand some simple indicators and how to use them properly. The tool I'm going to use today is the 40-day exponential moving average. If you're not familiar with moving averages, they are probably the most widely used indicators for most swing trading techniques. The moving average is a simple tool that helps us find the trend and, secondly, recognize changes in the trend. The simple moving average is calculated by dividing together the closing price for the entire period of data you want to use and dividing that amount by the total days you use. For example, if you want to calculate a simple moving average for the last 3 trading sessions, you would add up the closing prices together and divide that number by 3. Fortunately, every technical analysis program has the moving average built in, and you don't need to calculate anything by hand anymore. There are various types of moving averages. Some measure the averages of the high prices and low prices. Some measure the closing price, and some use advanced formulas to put more weight towards the more recent price than the earlier price data. This type of moving average is called the exponential moving average, and this is the one we will be using today. The major advantage of using the exponential moving average over the simple moving average is responsiveness. The exponential moving average is substantially more responsive than the simple moving average because the formula to calculate the exponential moving average puts more weight on more recent price data, while the simple moving average puts an equal amount of weight on all price data. There are 2 primary functions the 40-day exponential moving average helps me with. The first one is to make sure the market is trending. You may recall from an earlier tutorial my advice is to look at the slope of the market, and if it's sloping greater than 20% either up or down, it qualifies as a trending market. The 40-day exponential moving average can be used as a replacement for the 20-degree visual analysis. Let's take a look at a few examples so you can get a feel for analyzing stocks using the 40-day exponential moving average. In this example, Google is trending up strongly. You could see how it's trending above the 40-day moving average and how the 40-day moving average is lagging behind but is sloping upwards. Here's another example of Apple stock trending down strongly. You can also see how the market is trending below the 40-day moving average, how it's sloping greater than 20%, and how the 40-day moving average does a wonderful job of following this sloping trend. The second reason why many professional traders, including myself, use the 40-day exponential moving average is because it does a wonderful job when used as a risk indicator or a stop-loss indicator when stocks or other markets are beginning to move away from the trend. Let me give you a few examples so you could see what I'm talking about. You could see how Texas Instrument comes down and the 40-day exponential moving average is used as a stop-loss indicator to exit the market once it crosses below the 40-day exponential moving average. Here you could see another example using the Dow Jones ETF. Each time the market comes up and crosses above the exponential moving average, you would cut your loss. And every time it goes below the moving average, you would initiate your position. Both examples demonstrate the benefits of using the exponential moving average to determine trends and/or stop-loss risk levels. This indicator is one of the most important indicators for swing trading stock techniques. I will demonstrate a complete trading strategy using this method in the next few weeks. Thank you for joining us for today's tutorial. Please visit MarketGeeks.com for your free swing trading report, and don't forget to subscribe to our channel for swing trading videos and trading tips. This is Roger Scott wishing you the best in your trading.